Hello and welcome. My name is Brandon Wendell, Chartered Market Technician, and I'm going to go over the Ichimoku Cloud charting. We call this Head in the Clouds. We get a lot of requests about this and this style of charting, and to explain it a little bit more, and I'll let you know it's not something I use on a regular basis, but it is something I am very familiar with, and I use it from time to time, usually on larger time frames, to help identify trading opportunities, and it's something you might be able to use as well. So anyway, before we get started, just go ahead and let you know there are no guarantees implied with this strategy. Losses can and may occur. I'm presenting this strategy for educational purposes only. I'm not telling you to actually trade anything. Don't hold me liable for any losses you might have while employing this in any market. That's on you. There's always risk involved in the markets, and I'm not a licensed professional broker or anything like that, so I can't give you recommendations. Anything I do is just simply for educational purposes here. So that being said, Ichimoku is really just Japanese for one look. It was actually created by a reporter, of all people, not even a trader necessarily, but it was a reporter, a financial reporter who was looking at analyzing the markets from a different perspective. And really, it's a momentum indicator. It can show you some support and resistance, and it can also demonstrate with the direction of the trend, but it really just tells you how much momentum you have and if that momentum is changing. So it is going to lag slightly when you use it, but it's better than nothing, I suppose, and combined with other techniques can really become an effective tool to help you, as I mentioned, to really identify which trend you are in and when the trend is getting ready to reverse by weakening first. So that being said, if you've got a market that's really choppy sideways, it's probably not going to work too well because it works best in strong trending markets. So basically, there's going to be 5 different lines when you look at an Ichimoku chart. That's not including price. If you use price, you should probably use it as a candlestick rather than using it as a line, because otherwise it gets very confusing. But we have what's called the Tenkan line or standard line, depending on which brokerage you use. They have different names for them. Kinjun, which is the turning line, Chiku, which is the delayed line, and then Senku span A, first preceding line, and Senku span B, or the second preceding line. And those two preceding lines form what is called the cloud. So we're going to see how all that works. The standard and turning line can offer you possible buy and sell signals in the market, while the delayed line, or Chiku, basically tells you what trend you are in and if that trend is getting weak. So taking a look at these 5 lines and how they work, basically we'll start off with the standard or baseline. That's the, I'm not going to go through all the Japanese names again, but Tenkan, that's the standard or baseline. Again, depending on the platform you're using, they might label it slightly different. Anyway, all it is, it's a simple average. It's the highest high and the lowest low over a period of time divided by 2. And it's calculated from the past 26 days. These charts were originally designed for use on daily charts only. However, you can use them on any time frame. So when you look at let's say it's a 15-minute chart, it's going to use the last 26 candles. It'll find the highest high and the lowest low and add those 2 numbers together, divide them by 2, and that gets plotted on the chart. Of course, you move forward 1 candle, you drop off the oldest, and whatever the high and low is for the last 26 periods divided by 2. It could be the same or it could change over time. But it's the last 26 candles. So if it's a daily chart, it'd be 26 days. And if it's a 10-minute chart, it'd be the last, 260 minutes. So it's entirely up to you how you want to use this, but it's predominantly used on daily charts, as I mentioned. So the next line, or actually, I'm sorry, here's the baseline. I highlighted it in darker bold red there. You can see that's the baseline moving along. And as I said, it's just simply the last 26 candles high plus low divided by 2. And it just gets plotted on the chart. That's it. So if you're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. There's 26. So you take that low, because that's the lowest low, and there's the highest high. Add those 2 together, divide it by 2, and that's what's plotted right there. That's all it is. And if we get a new candle, we would drop off the oldest one, and then this would be our low. And of course, if this is still the high, then we would still use that. Anyway, the next line is the turning line, which is the highest high plus the lowest low divided by 2, same thing, but it's calculated over the last 9 days. So as you can see, instead of 26 days, we're only using 9 periods now, or 9 days, again, depending on the time frame you're using, It's just 9 candles. So this is going to be a little more sensitive because you're not using as much data, and it could show different highs and different lows. And basically, what you're doing is almost comparing two moving averages, a slower and a faster moving average, to kind of see the short term versus longer term trend in a security. That's really what this is kind of creating here. So now we got the blue line, that's the turning line, the other was the baseline. And you can see that when the market turned to the upside here, notice how the turning line went up faster and first before the baseline. That's because you're averaging only 9 periods rather than looking at 26. So you've got different numbers you're dealing with, and this should move faster. The blue line, you notice, moves faster to the downside than the red, and faster to the upside than the red does. Now the delayed line, this one's a little bit trickier. It's basically the current price. That's all it is, except you don't chart it right now. That's what your candles are for. What you do is you put it back 26 periods, I believe. Yeah, 26 periods ago. So if today happens to be the 20th of April, that would be displayed. Today's closing price would be displayed on March 23rd. And then if April 29th is the next day, you'd display that on March 24th. So you're literally taking the current price, and you can see it as a line and displaying it in the past. So here we have the current closing price, and it's back here 26 days ago. You can see that there's a peak 26 days before. That's where it's being shown. So this is literally the same thing as the candlesticks, just applied 26 periods ago. And that's going to help us identify what's going on with the trend. Okay, that's why we're doing that, because it's the delayed price and delayed action. So first preceding line, I mentioned this is actually part of the cloud. So the first three were just individual lines that you'll see on your chart. This happens to be the part of the cloud, the first preceding line. It is simply the standard line added to the turning line divided by 2. So remember that standard line was the last 26 highs and lows, or 26 period high and low, divided by 2, and then the turning line was the last 9 periods high plus low divided by 2, and we're simply going to add those two together and divide that by 2. That's all it is. And it's going to be plotted on the chart 26 days ahead of today, including today. So you count today as 1, and then you go forward 25 more days, and that's where you actually plot it. So the cloud will be plotted ahead of current price, not behind current price, like the delayed line is. So again, you don't have to do all this calculation, thankfully, because it's right there on your chart for you. The program does a lot of this for you. All you have to do is understand how to use it. But it's good to know how these numbers are created and what they are. That's why I'm going over it. So you can see the dark green or thicker green here. It's not really that dark. That is the first span, or the first preceding line. And it's basically, again, the blue plus the red divided by 2, but instead of plotting it right now, you put it 26 periods ahead. So you can see the cloud is always ahead of price. Now for the bottom part of it, the red, that's the second preceding line, and it's the highest high plus the lowest low for last 52 periods. So if you're on a daily chart, again, that would be last 52 days. If it's on a different time frame, it's just last 52 candles, and you divide that by 2. So that's the bottom of the cloud or top of the cloud in a downtrend. And that's pretty much it. Those are the different pieces that you put. And again, you're going to transpose that on your chart 26 periods ahead of the current price. So I made that thicker in the red here, part of the cloud. As you can see, it's the highest high, lowest low for the last 52 candles, but plotted 26 periods ahead of the current price. And that helps to create that cloud. So now you know all the different pieces of the Ichimoku Cloud, and we really just kind of really need to know how we use it, because just seeing what the pieces are doesn't make a whole lot of sense. It doesn't mean anything to us, but understanding how to use it, it's similar to moving averages. That's why this is really good for trending type of markets, because you're using averages that you can help to see what the trends happen to be on the securities you're trading. And the reason why they selected the numbers they did was that was back in the time that they created this. I'm not sure exactly when it was, but that was the traditional Japanese work week. So you had basically 6 days of work. You had 1 day off. And therefore, 9 days is a week and a half, and 52 days would be 2 months. So that's why the reporter came up with those particular numbers when it came to looking at charting rice and other products in the Japanese markets. So they were traded on a 6 day basis. Now, if you wanted to make this a little more modern, you can actually adjust the numbers because we don't have a 6 day week. We have a 5 day week for many of our securities. Maybe you have a little bit on Sunday, but not really a full day to count. So you could change this to 8, 21, and 42 rather than using the 9, 26, and 52. So it's up to you. If you want to make those adjustments, you absolutely can. It'll speed up the numbers a little bit, make them a little more sensitive. The lower numbers you use on any technical indicator, the more sensitive that indicator becomes. So you just got to be careful of that because it can give you a lot of false signals the more sensitive you make it as well. But it might be more accurate, especially if you're using Ichimoku on stocks that trade 5 days a week rather than using it on futures or Forex, which actually do have that extra trading period. So looking at this is what I'm seeing. I'm using TradingView right now for this. And if you're interested in using TradingView, by all means, it's not the only platform out there that offers this trading, but it's one that I typically use quite a bit. Actually, let me bring this over here for a moment. And it's going to say, if you're interested, I can give you a code to get 1 month free. Let me see if I can just find it. Refer a friend. Here we go. Copy. And actually, what I'm going to have to do is this. There it is. So if you're interested in getting TradingView and trying it out, you can try it out for free, obviously. There's a free version of it, but it doesn't have all the features involved in it. So if you wanted to go ahead and try it out and then sign up and get the pro version or even the there's different versions you can get. If you use this code that I'm showing you right there, just copy that down and use that, then you can go ahead and get a month for free for the pro version and try out all the interesting features that they have there and see if you like it. If you don't, that's fine too. I don't care. They don't pay me for it, but you got to use what you're comfortable with. And this, the Ichimoku trading is available on many different trading platforms. So if you have Thinkorswim or you have TradeStation or Interactive Brokers, you should be able to find it pretty easily anyway. But I just, like I said, happen to use this TradingView to help me out for a little bit as well. Sorry, my Brave keeps popping up some ads there. It's my browser. So anyway, this is an Ichimoku Cloud chart. I actually have this set up right now on State Bank of India. Somebody was asking me if you can use this on the Indian markets, and the answer is absolutely yes, you can. As you can see, I've charted the SBIN, and well, we'll talk about how this is working in just a moment here. So when we look at this, I actually have it back on the SPX, the S&P 500 index. We have all the pieces included: the lagging span, conversion line, leading span A, which is the cloud, baseline, the leading span B, and so on. So the way we want to use this is pretty simple. There's simple buy signals and there's complex buy signals. The problem with the simple buy signals is that you may be getting in too soon. So we're going to hopefully not make it complex, like it's difficult, but complex that it's going to filter out bad trades. So the simplest buy signal you could possibly receive is when the turning line goes above the standard line. That's it. So taking a look at the example here, I just took out all the other lines so you could just see those two. And remember, the turning line was the one that's based on the 9 periods versus the 26 period, so that moves slower. That's the baseline. So when the turning line goes up above the base, you'd want to be going long. Now, you can see this is not going to get you in at the very bottom of the move, right? You can see we bombed out down here. We get a buy signal a little bit higher, but it captures a big chunk of the overall trend. Sometimes it's a little late, just before things reverse, but that's okay too. Again, you're not trying to always be first. You don't want to be last, but you want to capture a good chunk of the move and therefore make good profits. So if you're waiting for that crossover, it would be the turning line going across the baseline, and that would be your buy signal. Now, if it crosses to the downside, that would be a sell signal. That's it. The turning line crosses below the standard line or baseline. So once again, looking at those two together, you can see that there's a sell signal, once again, not at the high. It's after we've come off the highs, but it's not also at the low either. So sometimes you're giving up quite a bit before that sell signal comes in. Sometimes it happens relatively quick, but that's just one way of using it for a sell signal. And of course, in a downtrend, we want to be more short anyway, not just selling. Here, we're looking at possibly exiting from a long, but I'm going to get into that a little bit more. So the simplest signal is just the turning line crossing the standard line. So that turning line is crossing the baseline. That's it. If it crosses upwards, it's buying. If it's downwards, it's selling. So to make sure that we're in a trend, one of the things you can look at is that delayed line. And if the delayed line is above the previous closes, remember that delayed line is current price, but shown back 26 periods ago. So once again, if you see that the delayed line is above the previous closes, you are currently in an uptrend. And if you see, well, actually, you see it below the previous closes, you're in a downtrend. So one of the things you have to remember is when I look at this, it's going to be a little bit off. The boxes are not necessarily going to be at the beginning of the uptrend because remember that delayed line goes above the past price 26 periods before. Okay, so that's why the move above right here was actually signaled right here. That's where it became confirmed that you were in a bullish trend. Right here, this dip below was confirming during this price action that we were in a downtrend. Okay, and then we had a small blip to the upside right there. And before that, we had a nice big move up, and that's what the big green area is. So the best way to explain this, I guess, would be to go back to the live chart. And let me take off everything except for the delayed line, because it'll make it much easier to understand when I do that. So if I go into the Ichimoku, we're going to take off the cloud. Excuse me. Baseline conversion line. Just look at the delayed line. And again, it's SBIN. Doesn't matter which security. So we're looking at the last 26 periods with this. Remember, that delayed line is the current price extended back 26 periods, right? So basically, you can see now on the hard right edge, that's the closing price. That's where the delayed line is. If we go to the previous one, see right there, that's where the line is. Previous close was way up here, and that's where the line was. So as of right now, we are confirmed in a downtrend, but we've only been confirmed in a downtrend for about 3 candles. And the reason why is, this is your downtrend right here, we only were below below price with the delayed line for those 3 candles that were formed right here, 1, 2, 3. So prior to that, we were in an uptrend until we actually touched. And let me just show you, because that's where we touched. Let me get this right here. It should be 26 candles. Oh, wow, I did it. Okay. So right here was the end of the uptrend when it touched previous price. And then if I keep going back now, we were in an uptrend. Let me see how long we were in that uptrend here. Actually, and clone that for a moment. You'll see why. It's easier as things are going in real time. It's not as easy when you're dealing with going back in history, trying to figure out where this was touching. So right there, okay, perfect. So this is right where we crossed above. So that means that the bullish trend was confirmed right here. See, that's where the crossover occurred. Actually, probably an easier way to do this would be get a trend line that's 26 periods long. There it is, 26 bars. And that's it. So what you do is you mark where did the crossover occur right here, and that's the beginning of the bullish trend. And you can see the bullish trend is where the delayed line stayed above the previous price, and that ended right there as we touched. And that's it. So the bearish trend, it was a very short-lived bearish trend back here. Only a few candles really. Started right there. Clone that. Bring it back. And put it right there. And let's see, we were below. Notice on the left-hand side, the delayed line was below the previous price until right there. So you can see that was a very short downtrend. Not very long at all. And there we were inside. Then we were still in a downtrend here. So this is how I created it. Like I said, it's much easier when things are actually live. You just look back to see, oh yeah, we're currently seeing the delayed lines below the past price. We're in a downtrend, period. We're done. That's easy. It's just this going back in time, which makes it a little bit more difficult. And let's see, that was continuing since there. Oh, it's pretty much right. So that was our bearish trend. So if we want to see where this bullish trend end, there is where we touched price. There. And then let's see where we first crossed over was right here. So there's your confirmed uptrend period. That's it. So that's how the delayed line works. You basically are taking the current price and drawing it 26 periods behind current price. And if you're above current price, you're in a bullish trend. Once you start touching price, the trend is getting weak. And then if you cross and you're below past price, then you are in a bearish trend. And again, if it touches, then of course the trend's getting weak once more. So that is the delayed line, using it for a trend indicator. So if you want to make it a little bit more useful when it comes to your trading, the Chikou span or lagging line, that helps with the trend strength. In an uptrend, like I said, you should be seeing that the delayed line stays above past price. If it crosses or touches, that's the warning sign that the trend is getting weak. It may have already topped out. Most likely it's already topped out, maybe getting weak and turning. Or it could just be a pause. You see the next one up right here, we're moving up, 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 and then there we simply pause in the trend before rallying once again. In a downtrend, you should see the delayed line stays below, and if you start to see it touch the previous price, that's telling you that the end of the downtrend might be happening. So once again, if I go back to my charts, see another way of doing this. And I'll do a different security. Actually, it doesn't really matter. I can use the same security. Let me just bring my little yardstick back, if you will. Oops, missed that. What was it? There we are. So, again, if we were trading right now, remember, we're seeing the delayed line where it is now. Okay, but just imagine it wasn't there, because it wouldn't be. When you're trading live, you'd be seeing chart action, but you wouldn't be seeing the delayed line right here. It'd be right there. That would be the end of the delayed line right now. That's where that green line would end. So I don't know if I can do. No, it's not going to let me, really. It's going to try to do the background in complete white. But I can't make it. Oh, there we go. So kind of get the idea. Again, you wouldn't be seeing any of that green line. This is, well, whoops, that didn't work. That's where the green line would be, right? Even though prices would be on the hard right edge. So anyway, right there, we wouldn't have much of a trend. So as we go forward, let me close that out. As we go forward, we still don't have much of a trend until right there, right here. Now you see 26 periods forward. Now we're starting to break down below past price, and that's confirming that we're entering into a downtrend. It's very confirmed right now, because as you can see, the past delayed line, that green line, would have been well below the previous price. So that's telling you you're in a downtrend. And we stay in the downtrend for a while. So again, just keep going down, 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 down. Still hasn't broken above yet until right there. So in going back real quick, let me just kind of draw this out and show you. This is where you got the first signal, technically be on this candle. That's where you got the first signal that we were going into a downtrend. So price would have been, oops, my bad. Did that wrong. That's the crossing right there. So that's where you would have been confirmed that you're going into a downtrend. That's where price was. Okay. And then you were told you were out of the downtrend right there. So if we hid this the line actually had, there we go. That's what would have happened. So right where this occurred, that's where the delayed line went below past price and was telling you you are now in a downtrend. And it's pretty obvious too, because you see prices are making lower lows. And then you stay in a bearish trend. And right there, that's telling you you're no longer in the bearish trend. You probably should be getting out of price if you're not already out of your short. So it didn't catch the absolute bottom, but it caught a good portion of the move down. And that's what we're trying to do anyway with the Ichimoku. So hopefully that makes a little bit of sense, that exercise I did to kind of show you what's happening with price action. All right, so again, if you're seeing the delayed line staying above past price, you're in an uptrend. If you're seeing it below past price, you're in a downtrend. And trend is, if it crosses the price, that trend is weakening. So the other thing to keep in mind is the cloud, or the Kumo. The Kumo is the cloud, is the difference between the two preceding lines we were talking about. And that acts as support or resistance. That's why we look at the cloud. If you're currently seeing price below the cloud, then it works as a resistance level. You're seeing price currently above the cloud, it works as a support level. Okay, now that's not as strong as the demand and supply zones that I look for on charts, but it can give you an idea of where prices might bounce. And if that support or resistance lines up with a supply or demand zone, then that's a high probability opportunity. That's going to be a much higher quality bounce and probability of it bouncing. So if you end up breaking above that cloud, if you go through the cloud, you're breaking out of resistance. And if you break down, then obviously you're getting a break of the support zone and possible moves down in trend. So really, you want to trade the breakouts long only if the trend is up, which would mean that the delayed line is above previous price and you're breaking through the cloud. The other thing you'd also want to see is a buy signal with the turning line being above or crossing above the baseline. And for a sell signal, if you're breaking the cloud to the downside, you'd want to have a go ahead to short or sell because the turning line is going below the baseline and the delayed line is below past price. So you get kind of all these things added up together to point out the direction you need to be trading in. So this is a more advanced buy and sell signal. You make sure you're only trading in the direction of the dominant trends. Don't trade while you're in the cloud. Okay, if you're flying through a cloud, it's hard to see anything. You just got to rely on your instruments and wait in this case. Now, the thicker the cloud is, the harder the resistance it will be to get through. Thin clouds are much easier to navigate through than thick clouds. So that's the same thing here. If you see a very thick cloud, it's a higher probability that your price will not be able to get through the area. And if it's a thin cloud, you're more likely to be able to break through. So here we have just the cloud showing right now, and it demonstrates, where prices can easily slash through when it's thin, or when the cloud gets thicker, it tends to bounce. Not always, but again, you see right there, we were able to break through a thin cloud, bounced off the thicker cloud, bounce off the thicker cloud, bounce off the thicker cloud, broke through the much thinner cloud, both directions. Bounce off the thicker. That was still medium and it bounced. Thick cloud, we bounced and held. There we were narrowing, but it still held. And in this case, we just kind of hung out in the cloud area. It didn't really help us at all. But often that can, again, the thicker the cloud, the harder it is for price to get through that area. This happens to be on the Dow Jones Industrial Average. Like I said, you can use this on any security. It even works on Forex. It can work on futures. It can work on stocks. And as you saw, stocks in different countries as well. So more advanced application. This is kind of what I was talking about. You want to wait for a confirmed uptrend. So if you see a confirmed uptrend, price should be above the cloud, as I mentioned, and the delayed line should be going above the previous closes. Okay, so you see that previous line, that delayed line is above the previous closes, confirming an uptrend. If you're in a confirmed downtrend, it would just be the opposite. The price is below the cloud, and the delayed line is staying below the previous closes. So if you get a buy signal in an uptrend, you go long, and you only exit, you do not short in an uptrend. Okay. If you get a buy signal in a downtrend, that would be your short exit. You don't go long in a downtrend. That's all. Just trade the direction of the trend. Remember, the cloud and the delayed line tell you the trend. The turning line and baseline tell you the entries and exits. So a sell signal would be shorting only in the downtrend. So getting back to this again, on the uptrend, let's say that we're currently seeing prices above the cloud and the delayed lines above the previous closes. Then if you happen to see the turning line go above the baseline, you would get in long, and when it crosses below, you would simply exit. And if you were in a downtrend where price is below the cloud, below the delayed lines below price, then you'd only be looking for shorts. So you'd enter short if you get the turning line crossing below the baseline. But if you get a buy signal, it's only an exit for your position. So right here, let's take a look. You've got a long entry. And the reason why is you see current price is above the cloud. And the delayed line going back a bit is also above the previous price. So you're in an uptrend. Then you get that turning line going across the standard line or baseline. That's your buy signal. So you go long here. And you stay long until there's your sell signal. That is not a signal to go short. The reason why it's not a signal to go short is you're still above the cloud. But your turning line went below the baseline or standard line right there. So you simply exit the trade. And also, if you're looking back, that means that, let's see, you're right there on the delayed line. So you're still above past price. So that's just simply an exit. Your short entry signal would be here now. And the reason why is you're coming out through the bottom of the cloud. So you're below the cloud. If you go back, the delayed line would definitely be below the previous price. So you're in a bearish trend. And you stay short until you get your buy signal. There it is, buy to cover. You're not going long here. And the reason why you're not going long, well, what if this was just a little retracement before we go lower? We are well below the cloud. And at this point, the delayed line is still below previous price. Notice just after that, this buy signal right there, that buy to cover, just after that, we started moving up in price. That's where we broke on the delayed line. So now you have the opportunity to go long if you wanted to right here. This is a little aggressive because you did have your buy signal way, way back there, but we're finally through the thin cloud. The better long entry would be to wait for an official long entry right there. The two crossed, turning line went across the standard line. And by looking back, you can see the previous delayed line is well above previous price. So you go long. And when you get out, when the market tells you, and it was right here where the turning line went below the delayed line. Or not delayed, sorry, the baseline. Gets a little confusing, doesn't it? Take practice. So, I mean, I can go out and take a look at some charts here as well, like we were doing earlier. Where are you? Oops. There we go. And let's go to, I don't know, Tesla. Let's bring up stock and go back to Ichimoku. Let's bring back all the lines. There we are. Okay. So if we go back in time a little bit here, where am I? Oh, in 2020. Okay, that's perfect. So here we are. Right now we're on a buy streak, but we didn't, I mean, our buy signal came in a little bit late right here. Now we couldn't go long, and the reason why you wouldn't go long right there is you're still below the cloud. And looking back, the delayed line would have been right here. As a matter of fact, for that delayed line, let me help us out just to know where it's going to be. Once again, I'll put in the 26 bars. There you go. So we could see when that line crossed over, the delayed line was right there. And it's below the previous price, isn't it? So that's how you can see it. So we did get a buy signal, but you wait to buy until you go across the cloud or maybe even a retest of the cloud. So the better long entry would have been right here. There. So we're going long, we're long, we're long, we're long. Let's bring our guideline along. And still long, look at that. Oh, there, now we have a sell signal. Okay. Now, did the trend get weak at that point? Not yet, no. Just going back on the delayed line, we're still above past price. Okay, we're well above the cloud. But right there, you see we had a sell signal where the turning line went below the standard line. So that would have been your long exit. That's a pretty good trade. Now you're getting in at what, 140 and getting out around 280. Yeah, I'd be pretty happy with that. So we'll continue a little bit more with this, and they're kind of staying together here. Now we finally got another buy signal. We are way above the cloud, obviously. So this buy signal happens on this red candle. It's a little late. And taking a look back, see, as that red candle forms, you can see that the delayed line is well above the past price. So that is actually a buy signal. Okay. So if you want to go long there, you're a little high in price, but possibility to go long. Looks like it's okay. You can see prices keep going, pulled back a little bit. Uh-oh, started to fall down. And unfortunately, let's see, did it work? Ew, there's our sell signal. Okay, so it took a little while. We kind of went sideways. The delayed line is still above previous price, but there's your sell signal finally telling you to get out. And the sell signal happened on that red candle. So you made a little bit of money, potentially, depending on where you actually got in. Let's say we're using the closing prices there. Oops. So it was a slight profit. And we wait, see what happens. Now we're not shorting here, and the reason why we're not shorting is you can see prices are trading above the cloud. And let's see, we actually do lose our uptrend at some point because, where is it? Right there, the delayed line on this pullback, the delayed line tags previous price, and that breaks the uptrend. It's telling you the uptrend's getting very, very weak. Now, it doesn't mean necessarily to go short, as I said, because we're still above the cloud, but it is a warning that the trend is very, very weak. So continuing on, we tag the cloud, and as we hit the cloud right here, look at that, it's a buy signal. Now, the only problem is, when you look back, oops, we are actually sitting with the delayed line below previous price. So we're not necessarily in a strong uptrend at all, but we are hitting the cloud, which is a support level, and we are getting the turning line crossing the baseline, which is a buy signal right there. And that actually happens on this candle. So if you want to take it as a long, again, you're sitting at support, you've got a buy signal. The trend might be a little lagging, but it seems to be working out okay. And, just kind of went sideways a bit, didn't it? And of course, this is why you might want to not take the long. As you can see, we came down and finally got the sell signal here, and you would have lost money on that. So that's why you want to kind of wait for everything to be in the right direction together. The buy signal that happened here, sorry, it was a buy signal. There it is, blue going across. The buy signal happening there happened while the trend was not in an uptrend. It was actually in a downtrend. So it told you not to go long, and by following the rules, you only go long when the delayed line is above previous price and you're above the cloud. You follow those rules, you don't lose money. Or, there's no guarantee, but not as much. So once again, we've got another buy signal on the hard right edge. I'll zoom in a little more so we can see it better. Let's see, there we go. So the buy signal happens, let's see, right here on this candle. Let me explain. On this candle, the turning line goes above the baseline, which is the magenta dark red. Let me get this line out of the way right there. See how they crossed over? So that's the buy signal. Actually, technically, it happens on this candle. And now we need to check to see where is our delayed line. Nope, it is not above, it's below past price. So we still can't go long because we don't have the confirmed uptrend. So if we waited, now remember, we're still moving up here. And finally, on this green candle, there it is, you can see that we're finally above the previous price, confirming that the trend is shifting upwards. So we had a buy signal earlier, we're above the cloud. We now get the turning line or delayed line going above previous price. If you wanted to go long, that's where you could potentially go long. If you try to go long here, you got to be careful because it might work sometimes. Like right here, there's your crossover, and we're above, well, technically we're in the cloud. But if you try to do that every time, oh, that's not the one. It was back here. That could get you into trouble. Because here is the other buy signal right there. Blue crossed above the burgundy. And you can see they would have lost money. This one, obviously, it's killing it. So there it goes and goes and goes. But if you do get the buy signal, it doesn't mean you have to enter right away. You can wait for the trend to go in your favor and then jump in a little late. Yeah, you don't make as much money, but you still would have been in right about here. And now, as prices are moving up, you're actually capturing some good profits. And you can stay in until you get your sell signal or the trend changes. So let's see what happens. Still going up, still going up, still going up. And there's your sell signal to get out. Finally. Now, as far as the trend changing, let's see. It did not signal the trend change actually till about the same candles, just a little after. But this would have been your exit on this candle here at about 800. So that was a killer trade if you were patient, getting in even a little late here at 448, getting out at 800 months later. So you can't go short. Remember, delayed line is right now touching, even if it does go down a little more. Now we're below, but we're also right above a very thick cloud. So since we're above a very thick cloud, we may not be able to get through the cloud too easily. Let's see, prices got stuck in the cloud, then it finally broke down. So now we're in confirmed downtrend. Prices are below the cloud. So if we get another new sell signal, we could definitely go short. And there it is. There's your sell signal. Okay, you got the turning line going. It tagged the baseline, now turned down again, or standard line. Standard and base are the same. So you look back and you can see that the delayed line is below the previous price, and we're below the cloud. So that's your shorting opportunity, the entry. That's what you look for. When you get out, when price tells you to, it looks like a cross right there again. So it was a very short-lived short, no pun intended. You can see pop back up. Unfortunately, just a small profit there. And let's see, we're poking through a thin cloud. Keep my yardstick here. Another sell signal, but we're in the middle of the cloud. And we could potentially go short here again. The reason why you could go short on this hard right edge is this. There's the crossover. Okay, you got the turning line going below standard, which is fine. You take a look back from the current price 26 periods ago, and you see the delayed line. Oh, wait, we can't. The delayed line is not below the previous price. It's above. You have to wait until it goes below, and that happened a couple candles later. So you wait for the confirmation. There it is. Now we've broken clear the cloud, and we're below the previous price on the delayed line. So now you can actually enter the short. And it started moving down a little bit. Unfortunately, there's the buy signal to get out. Oh, no, that's not unfortunate. You made some money. So it depends on where you got in. You'd be selling there. That's actually pretty flat. So it's not necessarily the best opportunity here, but again, we're not in a very strong trend. You saw you had that one really big payout with it went from about 440 to 800. Other than that, when you were not very strong trending, this can fail. As I said before, this is more of a trend indicator. So continuing on, see if we get another good buy signal here somewhere. All right, looks like we have one right here. We see the crossover actually happened on this candle. And with that candle, you see the turning line going above the baseline. You look back 26 candles, and the delayed line is above previous price, and you're also above the cloud. There's another long entry. You go long, and we haven't had a sell signal yet. Wow. We still have no sell signal yet. Look at that, still going up. And current price is still above the delay line. So you could still be in from what price was that? 700. And here we are at about 1136. So when it moves in a very strong trend, price that is, it can be a very effective tool. When there's not a very strong trend, it could be a little bit tricky. And as you see, we can use the cloud as a little bit of support or resistance when it comes to our trend. We often bounce off of the thicker cloud, as I mentioned before. So that can also be used as an indicator to help you. So when you're looking for signals, as I mentioned, you buy when price is trading above the cloud, right there, the price is above the cloud, and the conversion line crosses above the baseline. You should also see the delayed line is above previous price. And there it is again. You had the buy signal where you had the conversion line going above the baseline, and you're trading above the cloud, and of course, the delayed line's above previous price. Sell signals in downtrend, everything's just the opposite. You got the sell signal, price is trading below the cloud. We should see the delayed line is below previous price, and the conversion line crosses below the baseline. That's your signal to get in. And buy to close, obviously, when they reverse. So it takes a little bit of practice, but again, if you're not using this on a really high time frame, you'll have plenty of time to kind of analyze the signals. Even if you did use this on a smaller time frame, you still should be able to have some decent time to figure out what's going on. So if I were to go, as I mentioned, it can be used on Forex. Let's try USD JPY. Forex here, and let's try this on a 60-minute time frame. Right? We're looking currently, we are in a bearish trend. So I'm not going to go long right now, even though I just got a buy signal. That was simply a signal to close a long, or sorry, close a short right there. See? We have a cross above. That's the turning line or conversion line going across the base or standard line. What I should do here, let me see if I can do that. Settings. Where is it here? Scales. Indicator name label. There you go. So they call them base and conversion. Sometimes it's called turning and standard. So it depends on which one. But right now, you can see that in the blue, the conversion line went above the baseline, but we're trading below the cloud, which works as resistance. And going back, well, the delayed line is actually above previous price. So you could go long based on the trend. It's a small uptrend, but you're going to run right into resistance. So that's not good. You'd be better off shorting. So the short entry would have been back here as we were coming out of the cloud. You can see that, well, it was been, actually price would have been well below the cloud at that point. That's where the conversion line crossed below the baseline on this red candle right there. That would have been your short entry. And you can see that the delayed line was well below previous price. So that's your entry. And we just had the exit. So that was a win. 114.60, getting out. A little late here, but 113.62. It's almost 100 pips. And we can take a look at this on different security. As I mentioned, you use on futures, so maybe CLF 2022. Oops, crude oil. And I'll go down to a 15-minute time frame. So same thing, I can use this. I'm going to get rid of those labels. I actually don't want them there. It's too much. There we go. Okay. And right now, you can see we're entering into some bearishness. We're below the cloud. The delayed line is well below the previous price action right here. It has been for some time. We had a sell signal a while ago, but that didn't mean I can go short. It was just basically taking me out of any longs. So once we broke through the cloud, if I wanted to go short because we already had the sell signal here, we possibly could have. But just taking it back to a random period in time, let's do that. See how it would have worked. These futures. Here we go. So I'll play a hard right edge here. And again, for the turning or delayed line, I'm going to have to put in a trend line of 26 periods. Just let me know. There it is, 26 periods. So remember, because we're seeing the delayed line being put out forward, and it wouldn't be that far. It'd be right here, right then. So anyway, right now we've got a buy signal that happened back here. Not sure if that would have been a buy signal we could have taken a long on because, yep, we could have. The delayed line was above previous price. We were trading above the cloud, so you could have gone long right here. That would have been the long entry. Again, the conversion line goes above the baseline. The delayed line back here was trading above past price. And we were trading above the cloud, so that's a long entry. So we'll see how long it takes. It keeps us in till right there. Unfortunately, that would have been pretty much sideways, not much of a gain at all. Wasn't the strongest of trends either, but you can see that we had to cross back below. Yeah. Now we can't short there because we're not in a bearish trend. We were sitting at the cloud. So if you wanted to short, you had to wait until you went bearish on trend and or you went below the cloud. And actually, looks like right there, you can see we were starting to break below price. So we were going bearish. You could have shorted. You already had a sell signal happen. It actually happened again right there. There's separation between the two. So this would have been your sell signal right there. See how they're separating? The delayed line was below the previous price. You were already breaking through the cloud. So actually it would have been the entry for short would have been on the beginning of this candle. Hopefully it's giving you kind of an idea of how this works. So that would have been the sell entry. Staying short. Still going down. Still going down. That looks good. It's a nice one. And now we're out. And the exit is right here with that signal. I'm going to show you there's another way of doing some stops as well. But you definitely would have had to been out by that point because you had the crossing of the turning line above the standard, or turning above the base, whatever you want to call it. There it is. So in at 79.90, out at 79.50, we'll call it. So $400. Now, obviously, we could have made more. And let's take a look, see what else we can do as far as stops and things like that. Oops. So an aggressive long, price is already in an uptrend and becomes oversold, and you can buy when you cross above the baseline. That's an extra way of getting long. Instead of waiting for this buy signal that's very, very late, you can see we went above, we're above the cloud. The delay line's above as well. So if you want to go long, you simply wait for it to cross above the baseline, just jump in on that. You could do that. You saw I was also talking about breaking out of the cloud and taking a long or short based on breaking out of the cloud while you're also in an uptrend or downtrend as well. That could also work. So it's up to you. And in this case, once again, the price is in a downtrend and it becomes a little bit overbought. You can see we go above that baseline, but once you cross back below the baseline, you can go ahead and sell. And I always include demand and supply in my analysis anyway, so I'm going to be looking for those as possible entries and targets. But in this case, what happened was the entry would have been as we crossed that pink line right there of the baseline, you were already below the cloud and your delayed line was below previous price. You were in a downtrend. All you had to do is wait for it to cross below the baseline. Now you can take an extra entry. So you can be a little more aggressive there. Actually, oops, let me go here. See if I can demonstrate that. Cloud, we don't care about the delayed line and the conversion line. We're just looking at the baseline here. So same thing, you can see we're already moving down. Here we moved up and we're trading below the cloud. And as soon as you cross below that baseline and close below the baseline, you can potentially go short. Unfortunately, I would have stopped you out in that case. So it's not necessarily the best way, but it is a different way of looking at the price action. Now, a trailing stop, another way you can get out is if you close, so let's say we're in a downtrend and you close above the turning line, you can simply exit your trade. That'll get you out before the buy signals will. So you actually may be able to capture a larger portion of profits by doing that. Or if you're in an uptrend, if you close below the turning line, you can simply exit. Or if you cross the baseline, that can be used as another exit for a trail stop. So putting that to demonstration, let's see, we'll bring in both of those lines only. Version and base. There. So let's say we were in an uptrend here and we were long. We would stay long unless we close below the blue or break the red. There's the close below the blue, so you get out at the beginning of the next candle. Simple. So that'll get you out before you have to wait to get out for the crossings, and it might get you out much sooner with more profits. I don't have examples of good trades here, so if we go back to Tesla, I'll probably be able to find some. But again, there's a close below, you get out on the next candle. So let's see if we get another good trend going on here. Here we go. So we got a good trend. We had a sell signal here. Now we're short, and we can stay short unless we either close above the blue or breach that red with a candle. There's the close above, and there's your exit on the beginning of the next candle. If you were waiting for these two lines to cross over for your exit, you would have been giving back a lot more profits. See? There's the exit now, a little bit later. So that's another way of exhibiting a trail stop where you either close beyond the turning line or conversion line, or you simply break the baseline. That would also be your kind of fail-safe if you don't want to wait for a large red candle, a large green candle to stop you out. So let's see, there's another move down. So once again, if we're short, we're staying short unless we get a buy signal, but right there, that's why you get out on the break of that baseline. Don't want to wait for that close up there. But that's a good exit versus waiting for a crossing that didn't happen actually until here. So it would have been out much, much later. So that's how you can manage some of the trades that you're already in. You simply wait to see if you close beyond the turning line or if you break the baseline. This will take a lot of practice, obviously. If something that's brand new to you, it's going to take some time to get used to all this. But if you have any questions, let me know. That's kind of my wrap up there. That was my intro to Ichimoku Cloud charting with a bit of demonstrations. Like I said, you can use this on any security, any time frame you feel comfortable with. So hopefully you enjoyed that. And if you did, let me know in the comments. Hit subscribe as well so you'll be updated when I send out some new videos. I'll be doing some more as well as my weekly updates and everything. Until next time, everyone, trade safe, trade well, and take care.